Now, if you recall, we said earlier that if you want to buy or sell securities, the one way in which you can do this is by going through a securities or stock exchange, and the other is by buying securities directly on an over-the-counter market or selling them on the over-the-counter market. And we already said that this is a less or non-regulated form of securities transaction. The reason that this type of sale or purchase is referred to as an over-the-counter transaction, according to Ebert and Griffin, is because originally the traders, brokers, and so on kept securities on hand after stock exchanges closed, and whenever opportunities rose, they sold these securities to interested buyers over their office counter, and that's the advent of the term OTC, or over-the-counter. Now, the most well-known or most important over-the-counter market for securities in the United States is the NASDAQ system. That's an abbreviation for the National Association of Securities Dealers Automated Quotation System, and this is the world's oldest electronic stock exchange. And unlike, let's say, the New York Stock Exchange, where there's a physical location for trading to take place, the various purchase and sale orders are gathered in various computers and then transferred to a central network where they're executed. Ladies and gentlemen, that brings us to the final point of today's lesson, so-called mutual funds. If you do not possess enough income to put together your own portfolio of securities, then you still have the opportunity to participate in the securities market by buying yourself into a mutual fund. And a mutual fund is merely an investment fund that pools together smaller investments of small retail investors and buys a widely diversified portfolio of securities with this pool of cash. Now, if you want to participate in a mutual fund, you have to buy into it. You have to buy a share in the mutual fund. And because of this, we can distinguish between load funds and no-load funds. Both are mutual funds, but in the case of a load fund, you have to pay an initial commission to become a member of the mutual fund, to buy a share of the mutual fund, and you also have to pay a commission when you sell your share of the mutual fund. In the case of a no-load fund, you do not have to do that. The commissions are collected in other manners. Secondly, Ebert and Griffin compare three strategies that mutual funds can adopt. These are three different types of funds categorized by their strategy. The first is a money market mutual fund, and this is a type of mutual fund that invests exclusively in very short-term, very liquid debt instruments, meaning that the investment is usually very safe, but doesn't necessarily generate a very high rate of return for the investors. Similarly, there is a so-called balanced fund strategy, and balanced funds, once again, invest very conservatively. The aim is geared more at conserving the capital rather than generating an enormously high rate of growth, for example. This is the sort of investment that you want to take if you're preparing for your pension or something similar, where you want a safe, secure amount rather than let's say, capital that is at risk. If you're aiming for maximum long-term capital growth, then the third strategy or the third category of mutual fund might be of interest to you, a so-called aggressive growth fund. Here, as the name suggests, the mutual funds invest in a portfolio that consists primarily of companies or government bonds from emerging markets, dot-coms, etc., where there's a potential for very high growth, but also a comparatively high risk of default. Finally, Ebert and Griffin use three key terms that are important in regards to mutual funds, but also in regards to any form of investment. First of all, they talk about diversification, and diversification is used in regards to portfolio management. If you invest in a portfolio of securities, you don't want to include just one type of security because the risk is unnecessarily high. For example, if you only include stocks of Russian oil companies, well then if the oil market turns down or if the Russian economy turns down for some reason, then your portfolio is going to suffer an abnormally negative performance. So instead, when you diversify a portfolio, the idea is to include securities from many different investment categories to achieve a balanced growth potential. Now, depending on what percentage of your portfolio you invested in what type of security, your asset allocation will vary. The term asset allocation is just a fancy term that refers to the percentage of your portfolio that is invested in a certain form of security or other investment category. For example, if I have a portfolio that's worth 500 and 200 of that is invested in stocks and 300 of that is invested in bonds, well then my asset allocation towards bonds is 60% and towards stocks is 40%. The last term that they use is the risk-return relationship, and we already talked about this a little bit. Simply said, if you take on higher risk as an investor, you're only going to do that if you expect a higher return and vice versa. So the risk-return relationship basically insinuates that there is a positive correlation between risk and return. The higher the risk, the higher the potential return. The lower the risk, the lower the potential return. And that, my lovely students, brings us to the end of an hour on Chapter 16 of Ebert Griffin's Business Essentials. I hope you have happy remaining holidays, and I look forward to seeing you next week. Take care.